Hello and welcome to Marvellous Mortgages. My name is Christopher Dunworth and I'm a mortgage and protection advisor. And in these videos I'll run through the basics of getting your first mortgage and give you better understanding for any remortgages. And I want to kick off by looking at the word mortgage, because there's sometimes some confusion around it. So simply, it's a loan to buy a house, and that's it. Historically, the word comes from the Old French, and especially the Latin, and it means death pledge. So a cheery note to start off our presentation. In the US, they call it a home loan, which is what it says on the tin. It's a loan to buy a home. Especially important is that it's a secured loan, which means if you don't keep up repayments, the lender can repossess your home and pay off your debt. Most loans are unsecured. So for example, credit cards, store cards, and personal loans are typically unsecured loans, which means there is no asset to seize in case of default. Whereas the mortgage is said is a secured loan, and often at the end of all advertisements for mortgage products, they'll have the rider which informs you that your home may be repossessed if you fail to keep up payments on it, and which we'll come back to later. Most professions have their own jargon, and the financial services is no exception. So one of the first abbreviations you come to is LTV, and it simply means loan to value, which is the size of your loan or mortgage compared to the value of your home. So let's say you're borrowing $95,000 to buy your first home. You're putting down a deposit of $5,000. So the $95,000 is to buy a home worth $100,000, and the loan to value is $95,000 divided by $100,000 expressed as a percentage. So in this example it's 95%. Loan to value bands. So each lender normally offers different mortgage products, usually grouped into separate loan to value bands. So by the word lender, it could be banks, building societies, and other financial structures. And the higher the loan to value, the bigger the risk that the lender is taking, and so the higher the percentage rates. So especially at 95% loan to value, if you're just putting down a 5% deposit and the lender is lending you 95% of the value of the home, the lender is taking a great risk, and to reward their greater risk, the rates are higher, simply put. You tend to find that the better rates tend to be at 75% loan to value and below. So that means you have at least 25% deposit or equity in the property, and the lender is lending you 3/4 of the value or less. The main loan to value bands that lenders offer their products at tend to be the following percentage rates: 95%, 90%, 85%, 80%, 75% and 60%. Most lenders don't offer mortgage products or tend to offer mortgage products in all of these bands at the same time. They'll pick and choose, and they want to create their own niche in the marketplace and with the products that they offer to customers. So once the lender has chosen which loan-to-value bands they wish to offer products in for the customers, they often offer multiple products within each loan-to-value band that they're addressing. So possibly and typically 3 to 6 different products in each loan-to-value band. And so within each of these loan-to-value bands, there's a variety of different products, some of which charge lender fees, arrangement and booking fees for taking out that particular product with that particular lender. Some products have free basic valuation and some don't. Valuations and surveys we'll come back to in a later video. Some lenders offer cashback to the customer. Typical cashbacks are £250, £500 and £1,000, and these are usually payable within 30 days after completion by cheque, by backs and by direct payment to your solicitor. And also some lenders have different products depending on your credit file and rating. So credit files are especially important in terms of both getting a mortgage and remortgaging. And again, we'll look at this in a future video. So this information is important in terms of planning for loan to value. If you can access a cheaper loan to value, it could save you money in the long term. So what that means is if you're close to the next cheaper band, let's say you've got £7,000 or £8,000 as deposit and you're looking to purchase a house as set at 100,000, simple figures, your broker can advise you on possible strategies to put down £10,000, meaning that your loan to value is 90% rather than 95%, and that you access better and cheaper rates. Plus, when you're looking to remortgage in 2 years, 3 years, 5, 7, 10 years time, depending on the length of your fixed rate, you may find that you're dropping down a band or even 2 due to 3 main factors. So the first factor is obviously the effect of your regular monthly payments they've been making for your mortgage. Remember, those repayments each month pay off your capital and your interest, and in the early years it's predominantly interest. Secondly, any over repayments or overpayments you've made. Since your last remortgage, most fixed rate products allow you to overpay by up to 10% of the loan amount, existing loan amount. And again, your broker can advise you on this. And then the third one, which is underappreciated, if your home goes up in value since you took out your last mortgage, it can have the effect of lowering your loan to value in and of itself. And again, your broker can give you further advice on this. Two terms that you'll hear quite often are deposit and equity, and they're really the two sides of the same coin. So usually we use the word deposit when you're buying your first home, and this is the money that you may have in savings to put down on that purchase. So in our previous example of a 95% loan to value on a £100,000 house, you're putting down 5% or £5,000, so the deposit is £5,000. We tend to use the term equity for remortgages, and that is the difference between your home's current market value and the amount of your mortgage outstanding that you're looking to remortgage. So said, deposits and equity are two sides of the same coin. Two terms that often get confused are the mortgage term and the fixed rate period. And the fixed rate period we'll address in a future video. So I'd like to have a look at mortgage term. And very simply, the mortgage term is how long you're taking out the mortgage for in total. So historically, these tended to be 25 years. Whereas nowadays, there's greater flexibility. And to some extent, you can pick and choose under the advice of your broker, and most lenders will allow you to go up to just before your state retirement age for simple applications. And in fact, some lenders offer 35 and 40-year term mortgages today. However, and this is big however, the longer the term of the mortgage, the more you'll pay in interest. And we'll address this in a future video where I'll be comparing a 25-year term mortgage and a 35-year term, and the difference in interest you pay, and obviously the prevailing interest rate will also have an effect on this calculation. So as we normally advise, it's best to base your term on what you can comfortably afford. I want to round off this video by looking at associated costs, because I've seen too many customers that have their deposit but don't realise the other expenses in buying your home, especially the first home. So we can look at these each in turn. There are 5 main elements. These are stamp duty, lender arrangement and booking fees, survey or valuation fees, solicitor/conveyancing fees, and broker fees. So let's start with stamp duty. Stamp duty is a government tax for buying a house. We'll address this in greater detail in a future video, but basically if you're buying at below 125,000, there is no stamp duty. Plus currently, if you're a first time buyer and buying at under £300,000, again there is no stamp duty. Next up are lender arrangement and booking fees, which we talked about in a previous slide. So if the lender charges these fees for that particular product, typically they'll be £1,000. With survey or valuation fees, you have a choice. So you have a choice of 3 different surveys typically. The basic one for the lender is the mortgage valuation report. Typically that's £250, but some lenders include it for free in some of their products. Or you can have a home buyer's report, which typically for my customers is £500, and the full structural survey is £1,000. There are different variants of these, and it can depend on the purchase price of the property typically. And we'll look into surveys and valuations in a future video, because there's a lot of information around this. Most of my customers choose either the basic mortgage valuation report, which they won't see, it's for the lender's benefit, or the home buyer's report, which is more instructive. But again, we'll discuss this in a future video. One of the main costs of buying a home are the solicitor fees. So typically the search fees, which are payable up front for the various searches, are £300, and typical solicitor fees payable on completion are £1,000. All of these figures that are presented to you are the basic average and experience of my customers and working with them. Last but not least are your broker fees. If you're hiring a broker, typically they'll be between £350 and £599. And in summation, for your associated costs, excluding stamp duty, you can be looking at between £3,000 and £4,000. But it's possible to get that figure to under £2,000 on average if you're buying a home with no stamp duty, if you're selecting a product with no lender arrangement and booking fees, and if the lender is offering you a free basic mortgage valuation report, which you're happy with and is appropriate, then the first three categories out of the 5 are zero. That just leaves the solicitor and the broker fees. And finally, your home may be repossessed if you do not keep up repayments on your mortgage. Please join us for future videos, which we will publish on a weekly basis. Many thanks for listening.